So yesterday, if you recall, monetary policy is what we were doing, and we finished off this chapter. There was a lot of stuff that we did in this chapter, but ultimately we began yesterday at this point where we're talking about how monetary policy, as it starts at the Reserve Bank, starts through the Reserve Bank controlling liquidity by controlling the interest rate, the repo rate, and then getting involved in open market operations. So we started with this diagram of the market for reserves. Basically just the banks can control how much, the Reserve Bank can control how much commercial banks are able to borrow and at what price. And then we saw that essentially there are three different transmission channels through which monetary policy affects the economy. There's directly through bank lending, then there's sort of less directly through borrowing in other markets, so not through banks, but through actual loanable funds markets, and then through the exchange rate as well. And the exchange rate we didn't speak much about yesterday, so we're going to speak more about that today. And within this chapter, there's sort of a nice breakdown of the entire process by which monetary policy influences output and prices. So you want a summary of everything that happens, sitting there in chapter 31. Okay, and then finally we spoke about the fact that there are short run effects versus long run effects. And the long run effect of monetary policy is no changes to real variables, but changes to nominal variables. So price level can change in the long run when you have monetary policy actions. The nominal value of wages and the nominal money supply, these are all things that change in the long run with monetary policy, but not any real variables. So real output remains the same, employment remains the same, real wages remain the same, real interest rates remain the same. So monetary policy doesn't seem to have much of a long run effect. And even if it does, even to the extent that the monetary policy has an effect, it's actually very difficult to kind of understand all the different ways in which monetary policy affects the economy. And a really good example of that, in fact, is the fact that in the US, during the late 90s and early 2000s, it was a very low inflation environment in the United States, right? It was also pretty good growth, and interest rates were fairly low. And interest rates had been lowered in the early 2000s in response to the dot-com bubble bursting. So a whole lot of people had basically put a lot of money into basically speculative stocks about how the internet was going to change the way business was done, you know. So you bought into like a website, essentially. You know, you paid money to people who owned a website that was going to, you know, generate hundreds of millions of dollars of revenue because, you know, it was the early 2000s and everyone was like, get in there, right? It's like Bitcoin now, get in there, right? Yeah. So there was a dot-com crash which put the economy kind of into a bit of recession. Then there was 9/11 in 2001. Again, recession, right? So the Reserve Bank had lowered interest rates and was keeping them fairly low. And throughout the 2000s, there wasn't much recessionary pressure, but there also wasn't any kind of inflationary pressure. So there was no reason to raise interest rates. So interest rates were kept very low. And then one of the things that happened in end of 2007, 2008 was the financial crisis. And the financial crisis was a combination of a lot of things, but in many ways, the current thinking is that the Fed, the Federal Reserve in the US, so the Reserve Bank of the United States, it's called the Fed, the Fed kept interest rates too low and should not have been keeping interest rates low at that time, right? And then because it had kept interest rates so low, there was a whole bunch of different things that happened. There was something called ninja loans. Okay, so banks made ninja loans. So they made loans to people who had no income, no jobs or other assets. So that's ninja. No income, no jobs or other assets, right? Ninja loans. So loans were made to these people to buy houses, and then that became part of this whole junk bond problem, right? There was this, they called it toxic assets. So banks' balance sheets, well, they weren't really sure where these toxic assets were sitting on, whose balance sheets they were sitting on, because there was a whole lot of securitization that had happened where these loans were basically, you take a whole bunch of rubbish loans, you put them together into like a big pot, and then you kind of divide that pot up and you sell parts of that pot to different people. Securitization, right? So that happened, so no one was really sure. Anyway, so financial markets had a meltdown 2007, 2008, and the Reserve Bank was accused of keeping interest rates too low for too long. Okay? So when I say, even if you're targeting inflation or you're targeting recessions, right, there's still other stuff that can be happening without you even knowing it as the Reserve Bank. Like there's a lot of, you got to keep your eye on a lot of different balls, right? So what was happening in the 2000s in the US was trouble in financial markets that was not looking like inflation or recession. So the Reserve Bank, they knew that there was stuff happening, but it was a question of, well, what do we do about it? And also, we don't really have a mandate to do anything about it because we're targeting inflation. We don't have inflation problems. Post 2007, 2008, now there's a big focus on this other side of things, which is called Macro-Prudential Policy, and it's falls under something called financial stability. So inflation targeting is monetary policy, that's all about price stability. Then if you've got macro-prudential policy, which is about financial stability. So it's not just about inflation and general price levels, it's also about what's happening in markets. Anyway, very complicated but very interesting. So we saw that there's different ways in which the Reserve Bank can get involved in the economy and make things happen. If you're kind of a mathsy person and you like doing fancy models and that sort of stuff, you kind of actuarial science leaning, then it's a really interesting. Financial engineering is a very interesting field. Can make a lot of money, cause a lot of problems. Cool. And that's the end of chapter 31. So we move on now to chapter 26, which is now the foreign exchange stuff, as well as balance of payments. So balance of payments is kind of like accounting in economics, except it's kind of weird accounting. It doesn't really work like accounting works, because only half the transactions are recorded. We'll get there. Anyway, so first of all, exchange rate stuff, talking about foreign exchange markets, and then we'll come to balance of payments next. So, a whole bunch of stuff to do today. We're going to describe the foreign exchange market and define the exchange rate. We're going to explain how the exchange rate is determined. We're going to explain the factors that influence the demand for and the supply of rands, and show that the demand for and the supply of rands graphically and indicate where equilibrium would be in that foreign exchange market. Then we will evaluate the effects of a change in demand for or supply of rand in the on the equilibrium exchange rate, and we're going to show that graphically. So the normal kind of thing that we've seen before, we've got a market where we've got price and quantity on our axes, and we've got demand and supply, except now it's for foreign currency, or our currency. Then we're also going to distinguish between a nominal exchange rate and a real exchange rate, and just take a look at how we calculate the real exchange rate, and explain trends and fluctuations in the exchange rate, explain interest rate parity and purchasing power parity. So some new terminology, some new concepts to introduce. Describe the alternative exchange rate policies and explain their effects. So that's all about the market, the market for foreign exchange rates, foreign exchange markets. And then after we've done all of that, we'll look at the balance of payments. So we'll discuss the balance of payments accounts and explain what causes an international deficit, calculate various balances of balance of payments accounts. Alrighty, so we'll do that in the second half. Okay, foreign exchange. When people buy stuff from other countries, they have to use the currency of that country in order to buy their stuff. So you want to buy US goods and services, first you have to buy dollars, then use those dollars to pay for the goods and services. And the way that you buy those dollars is through the Reserve Bank. So if you do an online transaction, you buy something from overseas using your credit card, for example. Your credit card is with a local bank. You tell your local bank, I want to buy that stuff in dollars. Your bank has to buy the dollars from the Reserve Bank, right? And give those dollars over to whoever it is that you're buying from. Okay, so your bank then takes the rands out of your account, gives those to the central bank, and then purchases dollars which get given to the American people back over there. So obviously if you want to buy dollars, you first have to be able to buy the dollars. In other words, the Reserve Bank first has to have dollars available. How does the Reserve Bank get dollars? Well, same thing. If people want to import from us, they've got to buy in rands. So if there are people in the US, they want to buy our stuff, they take their dollars, tell their bank, right, I want to buy South African goods. Their bank has to interact with the Fed, their Reserve Bank. Their Reserve Bank, right, interacts with our Reserve Bank. Okay? So it'll buy the rands from our Reserve Bank. Okay? And our Reserve Bank buys the dollars from the American Reserve Bank. And through these transactions, the dollars go back and forth and the rands go back and forth. And at the end of the day, there's not much of a change in the quantity, if that makes sense. In other words, we send dollars over, but we also bring dollars back over here. So the quantity kind of doesn't fluctuate too much. But when it does fluctuate, then you have a change in the exchange rate, which is what we're going to see. So trading currencies. The currency of one country is exchanged for the currency of another in a foreign exchange market. And we end up with exchange rates. And an exchange rate is the price at which one currency is exchanged for another currency in that market. Okay? So it's the price of a dollar or the price of a rand. And a strengthening of an exchange rate is what is called an appreciation, and a weakening is called a depreciation. And that actually is a little bit confusing in the South African sense, and I'll explain right now. But in other words, a strengthening of an exchange rate, in other words, if the price of a currency goes up, that's called appreciation. A weakening of an exchange rate, when the price of a currency goes down, that's called depreciation. Now, when we think of, or if you watch the news or you listen to the radio and you think of the exchange rate that you hear quoted, right? You will hear something like, it's currently around 13 Rand 50 to the dollar. That's the exchange rate that you hear. What you're hearing is in fact not the price of a rand, you're hearing the price of the dollar. 13 Rand 50 per dollar, right? Whereas in the US, it would also be quoted as 13 Rand 50 per dollar, if you get what I'm saying. In other words, they're interested in the price of their dollars. For some reason, we're not interested in the price of our rands. We quote it as the price of the dollars, right? It's weird. So you get how many rands per pound, how many rands per euro, okay, as opposed to the other way around. The other way around should be approximately 7 US cents per rand. That's the price of the rand. It's about 7 US cents for 1 rand. Okay? It used to be about, well, I say used to, whatever, a long time ago. In the 1960s, I think it was about $3 to the rand. And now it's about 7 US cents to the rand. So, 13 Rand 50 to the dollar is the price of a dollar. So when the price of a dollar goes up, In other words, if it goes from 13 Rand 50 to 16 Rand to the dollar, that's appreciation of the dollar. But we normally think of that as depreciation because it's the depreciation of the Rand, right? That would be 7 US cents per Rand down to 6 US cents per Rand, as an example, right? That would be depreciation. So the way that we look at the price of the Rand is a little bit backwards. We don't price the Rand, we price other currencies, and then we talk about appreciation of the Rand or depreciation of the Rand, right? Even though we're giving the price of the other currencies. So just be aware of that. It's a little bit backwards in the way that we normally deal with it, but when the price of a currency goes up, that's appreciation. So when it goes from 13 Rand 50 to the dollar to 16 Rand to the dollar, that's appreciation of the dollar. Okay? But of course, appreciation of the dollar means depreciation of the Rand if we are pricing dollars in Rands. Okay? So if the price of a dollar in Rands goes up, by definition, the price of a Rand per dollar must be going down. Okay? So appreciation of one currency must be depreciation of the other currency if we're talking about the prices of those two currencies relative to one another. So the exchange rate is a price, and it's the price of one currency in terms of another currency. The foreign exchange market is a competitive market, so there are demand and supply relationships which determine the price. So first of all, we're going to look at demand. But even though we're looking at demand, of course, when people who are holding the money of one country want to exchange it for the Rand, they demand Rand, but in demanding Rand, they are also supplying the other currency. Okay? So even though I'm talking about demand, we start just talking about demand for a currency, you must understand as well that any demand side's discussion basically has an equivalent supply side discussion. So you'll see that everything that affects demand can also affect supply, because the demand side is also the supply side of it. The demand side of one currency is the supply side of the other currency. So anything that affects the demand side of this currency affects the supply side of the other currency. Okay? So people buy South African Rand in the foreign exchange market so that they can buy South Africa's goods and services, which we export. So they want to buy our exports. They also buy South African Rand so that they can buy South African assets. So they not only want to buy our goods and services, which we export, they also want to buy our assets, which we can't really export. In other words, if a foreigner buys a factory in South Africa, it's not like they pick the factory up and take it over there, right? So when they buy our assets, the assets don't get exported out, but we still sell stuff. It just stays in the country. It's just a question of who owns it, which is why the JSE is actually got a large foreign ownership. A lot of the JSE is owned by foreigners. I don't know the exact figures, but it's at least 25%, and it could be more. Could be more, but yeah. I'll actually check that because I'm interested. So they can also buy South African assets, such as bonds or shares, and businesses, as well as property. The quantity demanded depends on many factors, but the main ones are, obviously, whatever the exchange rate is determines the quantity demanded. Okay? So when the exchange rate changes, we change the quantity demanded. Change in quantity demanded. Whereas any of these other factors here would be a change in demand, which we call a shift. Okay, so a shift in the demand curve. Okay, so in other words, if suddenly people decide they want more of our goods and services, regardless of what the exchange rate is, that will shift the demand curve for rands. Okay, so one question in an exam somewhere says, for example, Americans decide that they love Mrs. Ball's chutney, right? They just start exporting, right? Well, we start exporting. They just start importing the stuff en masse. That increases the demand for South African rands regardless of the exchange rate. Okay? Interest rates in South Africa and other countries, we spoke about it yesterday. We introduced the idea that when foreigners buy our bonds, they're interested in the return. If our interest rate goes up relative to the rest of the world, that makes the return in our country higher relative to the rest of the world. That means people want to buy our assets. That increases demand for rands when people want to buy our assets. And then, of course, there's the expected future exchange rates. So we've seen before, when expectations about prices change, we have shifts in the demand or supply curves. Same thing happens in the foreign exchange market. When expectations about future prices change, that causes shifts in the curve now, which can then become a self-fulfilling prophecy. In other words, you think the prices are going to go up, so you buy now. And because you buy now, you increase demand, and when you increase demand, prices do go up. Right? Self-fulfilling prophecy. That's why in financial markets you can end up with what they call a bubble, where basically people just keep on buying and the price keeps on going up because everyone believes the price is going to keep on going up. Until people suddenly stop thinking the price is going to go up, and then the demand stops increasing and the price collapses. Then you have a financial trouble of some kind, and you hope it won't become a financial crisis. Okay, so the law of demand then, it's a normal story. The higher the exchange rate, in other words, the higher the price of rands, the smaller the quantity of rand demanded. Normal story. The higher the exchange rate, in other words, the higher the price of a rand, the smaller the quantity demanded. It's a downward sloping demand curve. And why is it downward sloping? Well, there's two effects. There's an export effect, and there's also an expected profit effect. What is the export effect? We've spoken about it before, essentially. The larger the value of South African exports, the larger is the quantity of rands demanded in the foreign exchange market. But the value of South African exports depends on prices. So if locally produced goods and services, right, expressed in the price of a foreign currency goes up, right? So in other words, if our exchange rate goes up, if our exchange rate appreciates, means the cost of our goods and services in foreign currency is going up. Yeah? If we appreciate, if it starts costing more dollars per rand, the rand appreciates. So it costs more US dollars per rand. We go from 7 US cents per rand to 8 US cents per rand, right? Then it means our exports become more expensive in US dollars, right? And you know what happens when the prices of goods go up, the quantity demanded goes down. So that's one of the reasons that we have a downward sloping demand for rands curve. In other words, when the price goes up, when the price of rands goes up, the quantity demanded decreases. And then there's also an expected profit effect, which is to say, the lower the price level of the rand, okay? So if you got US dollars per rand, okay? If it's 6 US dollars per rand, and you think that the rand is going to appreciate, and you're a US investor, one of the things you could do is buy rands at 6 cents per rand. When the price goes up to 9 cents per rand, then you sell your rands and you make profits, right? In US dollars, speculating on currency. The lower the price of the rand, the more likely you are to think, okay, you know, there's a good chance it's going to appreciate. In other words, the further and further it falls, the more likely it is that the only movement would be up, if that makes sense. As a speculator, I mean, this is a risky business here. Yes. Do they apply for? Yeah, look, cryptocurrency is a currency, and so it's just a financial asset in a sense. Okay, so it behaves like every other financial asset. You have demand and supply. our demand would have the same thing. You would have maybe not an exports effect, but depending on the exchange rates, you're going to be buying in, say, cryptocurrency, Bitcoin. Then the lower the price, the more transactions you want to do in that currency. Or shall we say, if someone is pricing their goods in that currency, then the lower the price of that currency in your currency, the more you would want to buy in the Bitcoin currency. But Bitcoin's not controlled by a country, so it's not like there's import-export related to a country. It's more like, are you pricing in Bitcoin or not, right? Would be the one issue. The second issue is the supply of Bitcoin, especially. I don't know about other currencies, but Bitcoin especially has that mathematical. It's basically like a logarithmic function that says the amount of Bitcoins that will be produced over time gets smaller and smaller and smaller and smaller. So there's a finite level of Bitcoins that will ever be produced. So you can imagine then the supply is fixed. In which case, if the supply is fixed, the supply side is not gonna change. Yeah. They do, but remember the Reserve Bank can change it. They can increase it, they can decrease it if they want to. Can't change it, no. It's there. Apart from people losing their Bitcoins, which people do, right? The supplier just sits there. When I say losing Bitcoins, there was the story of a guy who had 5,000 Bitcoins about 6 years ago, and he just had them because he was like, whatever, I'm interested. And he had them on a hard drive on his computer. And then he changed his computer and he chucked his old computer away. And 5,000 Bitcoins is worth, I don't know, now about $1 million or something. So, yeah. So now that's sitting in some like scrap heap somewhere. And those things are gone. So yes, it does apply. It's just the dynamics of it are slightly different because it's not controlled by a particular nation. Yeah, I'm not a fan of Bitcoin myself. I think it's a stupid system, but that's just me. Because I think limiting supplies. Well, what happens when you limit supplies? You get exactly what happens to Bitcoin. Bitcoin was, I think, it was about $2,000 a coin about 3 months ago. It's about $4,000 a coin now. About 6 months ago, it was about $3,000 a coin. About 12 months ago, it was $500 a coin. It's just like, it's not what you want in your currency. You want your currency stable. Bitcoin is not stable, so it's not a good currency for. Sorry? Now, like I say, it moves so much every day. I couldn't tell you. In dollars. Is it higher in dollars? It's about $4,000 per Bitcoin. I think. I don't know. Like I say, it's like all over there. We'll take a look at the exchange rate just now. So we got the demand for rands. It's downward sloping, and a change in the exchange rate brings about a change in the quantity of rands demanded and a movement along the curve. Okay, normal story. So that's the demand side. What about the supply side? Well, the supply side looks suspiciously like the demand side because the demand for one currency is the supply of another currency. So the quantity of South African rand supplied in the foreign exchange market depends on, well, obviously you've got the exchange rate causing a movement. Okay. And then you've got 3 other factors causing a shift. And what are those factors? Demand for imports. And remember that on the demand side, it was demand for exports. On the supply side, it's demand for imports. On the demand side, depends on the interest rate. On the supply side, well, it also depends on the interest rate. On the demand side, it depended on the expected future exchange rates, and on the supply side, depends on expected future exchange rates. So surprise, surprise, basically the same factors. It's just the other way around. So what is our law of supply? The law of supply is that the higher the exchange rate, the greater the quantity of South African rand supplied in the foreign exchange market. That makes sense. the higher the exchange rate, in other words, if we moved from 9, or let's say from 6 or 7 US cents per rand to 9 US cents per rand, that means that the price of US goods and services gets cheaper for us, right? If we go from 7 US cents per rand to 9 US cents per rand, we can buy more US cents per rand. So our rand buys us more US goods and services. So if our rand is buying us more goods and services, the higher the price of the rand, the more we are going to be importing, which means the more rands we're going to be supplying into the foreign exchange market to buy foreign goods and services. We're going to supply rands in order to buy dollars to buy those US goods and services. Obviously, the exchange rate influences the quantity of rand supplied, and there are two reasons. In the demand side, we had an export effect. On the supply side, we've got an import effect. Obviously, it just works in the reverse. Okay? Which is to say, the value of the South African imports depends on the price of foreign produced goods and services expressed in rands. So the prices will depend on the exchange rate. Obviously, the higher the rand exchange rate, the cheaper are those goods and services, the more we want. And then there's the same thing with an expected profit effect. Okay? So the stronger the exchange rate is today, the larger is the expected profit of selling rands today and holding those foreign currencies. So the greater is the quantity of South African rand supplied. In other words, if today it's 13 rand 50 per dollar, okay, tomorrow it suddenly goes down to 10 rand per dollar, I will be at ABSA and I'll be like, buy me them dollars. Buy it now. All of it. Whatever the money's in there. Just buy it. Because I'm going to be pretty sure, right, that it's going to weaken again. The rand is going to weaken again. Right? So when the rand appreciated, I wanted to buy dollars to speculate on the rand depreciating again. You with me? Okay? When the rand appreciated, so we went from 13 rand 50 per dollar to 10 rand per dollar. That's the dollar depreciating, that's the rand appreciating. The rand appreciates. The higher the exchange rate for rands, I want to go and buy those dollars and I'm going to hold them because I'm pretty sure next week we're going to be back at 13 rand 50. Then I'm going to sell my dollars and I'm going to take my rands and I'm going to just wipe them on my face and bath in them, right? So when the exchange rate appreciates, there's more speculation. More people want to buy dollars or sell rands on speculation that it's going to depreciate again, right? And obviously, the more and more and more and more it appreciates, the more that kind of speculative activity takes place. So now, obviously, we've got a supply curve. Supply curve is upward sloping, and a change in the exchange rate brings a change in the quantity of rands supplied. And we have a movement along the supply curve. Okay? So what about market equilibrium? Well, we've got downward sloping demand, we've got upward sloping supply. And equilibrium is where they intersect. And that gives us our exchange rate. That's the price. Now, we can also shift demand. Why is demand going to shift? Well, look at our options here. We've got a change in demand for exports, a change in interest rates, and a change in expectations about future interest rates. So we've spoken about all of those things. Why might demand shift when there's a change in any of these factors? Right? Then on the other side, why might supply shift? Well, the same, just the inverse of those. Change in interest rates, change in demand for imports, change in expectations about future exchange rates. Those are going to shift our curves. What I'd like you to do now quickly is get out a piece of paper and a pen. Okay, and I'd like you to draw two markets for me. One, I would like you to draw, and I will draw it with you, and then you can draw the second market. First, I would like a market for rand. So if I'm drawing the market for rands, I'm plotting quantity of rands against price of rands, and I want to do price of rands in terms of US dollars. So how would I give the price of a rand in terms of US dollars? It would be dollars per rand. Okay? This is the market for rands. I've got quantity of rands and price of rands. Market for rands. Or rand, I don't know. Rands. We were having a discussion about this the other day with foreigners. So they're like, is it rand or rands? It's like, I have no idea. We use both. Okay, so we've got a market for rand or rands. Now, we're going to have a demand curve and we're going to have a supply curve. So again, supply of rands, demand for rands. And we're going to have an equilibrium exchange rate, and I'm going to make it 0.1, because that's nice and easy, dollars per rand. Okay? And then there's some quantity, who cares what the quantity is, Q star. Okay. Now I would like you to draw the market for dollars. Okay, market for dollars next to market for rands. And I want to know, and I want you to indicate over here what the exchange rate would be. So draw that quickly, and then we will use these diagrams to do something. Okay. So what is this market going to look like? Obviously, if we're plotting the market for dollars, we've got quantity of dollars, and we've got price of dollars. In terms of rands, it's going to be rand per dollar. So we've got a demand for dollars, and we've got a supply of dollars. And we've got some equilibrium exchange rate. What is the exchange rate going to be? It's going to be 10 rand per dollar. If it's $0.1 per rand, then it must be 10 rand per dollar. It's the inverse of whatever. $0.1 per rand, then 10 rand per dollar. And we got some quantity, call it Q star. Okay? So here's your exercise. The South African Reserve Bank. Okay? No, screw that. Not even the South African Reserve Bank. The Fed, the US Fed. Okay? Because this is what's just happened. Well, might just well, whatever. It's been happening. Doesn't matter. Let's just say it's topical. Okay, so the Fed, the US Fed, decides that this whole quantitative easing business needs to come to an end. They're worried about inflationary pressures. They're going to raise the interest rates. So they raise their interest rates. The US raises interest rates. What happens? So, what I have heard so far, and correctly, is that if the US Fed is increasing their interest rates, we would expect an increase in the demand for dollars. Why are we expecting an increase in the demand for dollars? Because South Africans want to buy the financial assets of the US. So we want to buy their financial assets, so we need their money, right? So there's an increase in the demand for dollars. But that increase in demand for dollars comes from something in the market for rands. We're buying those dollars with rands. So what happens? We're supplying more rands into the market. So the supply of rands increases. Okay? What do we see in the market for dollars? What happens to the dollars? The price of dollars, there is appreciation. The price of dollars goes up. Appreciate. Okay, so dollars appreciate. What happens to the price of rands? Rands depreciate. Okay, and there was a change. There was a change in the markets. There was an increase in trade in these markets. So there was an increase in the number of rands traded and an increase in the number of dollars traded, as South Africans purchased more US financial assets.